Hi, I'm Kep Kepner, CPA here in Dallas. There's a lot of talk these days about the tax rates, and a lot of people are screaming about the fact that the highest tax rate is 39.6%. As a practical matter, many of you may not know this, but the highest tax rate in 1958 was 91%. Yeah, I wasn't joking about that. 91% was the highest tax rate. There were 24 different tax brackets. Today there are only 6. So what happened between the late 50s and today? Well, when Reagan came in, he lowered the taxes dramatically, and the amount of money coming into Uncle Sam grew exponentially. Well, why is that? If you're a business owner and you're being taxed at 91%, what is your incentive to make a lot of money? Well, there really isn't any incentive. So what you want to do in that case is you want to build the value of your business. You want to buy a bunch of toys and include them as part of your business assets, that travel trailer, that extra car, all of those kinds of things, so that you could end up showing no profit or a real low profit. What else do you do when the profit, the tax on your profit is 91%? Well, the other thing you can do is you can go out and buy losses. So if you find another company that has losses, you buy that company and you offset those losses against your earnings. So the IRS isn't stupid when it comes to tax strategies. Along with lowering the tax rate by more than 50%, from 91% down to 39.6%, they've also tightened up some of the loopholes. So you can't any longer go buy a company that's having losses and use those losses in your business. Okay, the IRS has rules about the ownership of that business and how long you have owned it and whether or not you can take those losses. However, using some really astute tax planning, perhaps there's a way that you can do that. One example would be to buy control of a business that is throwing off losses, have your profitable company pay the other business for services so that you get the benefit of those losses in your successful, profitable company, and then pay yourself a salary to use up the cash that's in the company that has the losses. So if you're really astute and clever about this, you can control some of that. At the same time, the IRS, through their auditing, has cracked down on some of the unusual things like putting all the kids' cars in your business. Well, as a fact of the matter, you could probably still do that. You could call them business vehicles. But the fact of the matter is, it doesn't mean quite as much when you're only writing off that expense in the 30 to 40% range instead of the 89 to 91% tax range. So as a taxpayer, we're less interested in going way out on the limb by some of these crazy deductions. So really, tax planning is a business decision. It's not a tax decision because you want your business to make money. You want to pay taxes. You want to pay the least amount of taxes you can, but you still want to have a profitable business. So if you need help with that, let us know. We can help you. Thanks.